Traditional data centers process static information, but in the modern era, AI neobanks actually manufacture real-time intelligence from the ground up. When infrastructure engineers evaluate these systems, they traditionally measure efficiency by looking at the hourly rate of the hardware to calculate flops per dollar. Relying on the hourly lease of a chip assumes a linear workload. For complex AI reasoning models, that metric creates highly inefficient and expensive architectures. This equation shows how we calculate the total cost of ownership. You divide the hourly hardware rate by the number of delivered tokens generated per hour. To build a profitable operation, the focus must shift to the bottom half of that equation. We have to engineer the pipeline as a factory optimized to maximize the denominator. The upgrade to Blackwell-class architecture establishes our new baseline. These physical boards carry a higher acquisition cost, meaning the hourly compute rate effectively doubles. This chart comparing Hopper and Blackwell architectures shows that if you only look at the numerator, newer silicon seems inefficient. You double the initial expense just to turn the system on. But when we evaluate the raw throughput, the tokens per second per watt, the output scales so aggressively it overwhelms that premium. By plugging that massive token production into the denominator, the final cost per million tokens drops by a factor of 35. For Sigma BankAI, securing the most expensive hardware on the market is an economic imperative because manipulating the denominator creates the lowest baseline token cost. This iceberg graphic illustrates that the hourly rate of the physical chip is only a surface-level factor in AI economics. The true multipliers for token output lie beneath the surface, hidden in the architectural and algorithmic isolation of the software. The first subsurface multiplier is algorithmic precision. For high-speed interaction models, we compress the data structure down to a 4-bit floating point format, known as FP4. By quantizing logic, massive parameter blocks compress into highly dense units, clearing memory bandwidth bottlenecks. With a smaller footprint, the hardware pushes data through the pipeline at significantly higher velocities, retaining strict accuracy for neobanking. By shrinking the data precision, we artificially inflate the denominator of our TCO equation, packing more financial intelligence into the exact same hardware footprint. Deep reasoning requires a different approach. Large reasoning models process logic through a chain of thought, meaning individual thought tokens are incredibly expensive to generate. Activating an entire neural network for a single token wastes immense power. We solve this with mixture of experts, restructuring the model into specialized subnetworks. Now, routing mechanisms activate only the most relevant subnetwork, leaving the massive grid dark. This selective activation severely restricts the number of parameters needed per token, driving down the active compute cost for complex logic. Mixture of experts turns massive, slow reasoning models into highly agile engines, guaranteeing that infrastructure isn't wasted on irrelevant parameters. The Sigma BankAI OS operates on a dual model dynamic. It balances the deep institutional logic of the large reasoning model with the rapid execution of the small reasoning model. Our third multiplier links them together, speculative decoding. This positions the small model as a low-cost drafting engine for the heavier architecture. During drafting, the small model generates a sequence of potential tokens at accelerated speeds, using a fraction of the compute cost. The massive reasoning model then sweeps over that draft sequence in one parallel motion, verifying logic and discarding errors. Because verification is computationally cheaper in generation, this parallel process speeds up logic output by a factor of 2 to 3 compared to the large model operating alone. Speculative decoding allows the OS to process logic at high velocity, providing real-time subscriber responses, without forcing us to linearly scale hardware costs. These architectural choices exist to support aggressive business stakes, preparing the Sigma testnet deployment to support an acceleration toward 1.5 million subscribers. Returning to our initial equation, the top-line hardware cost remains the same, but the denominator is now fully loaded with our specific architectural multipliers. Unifying the post-training stack with these software factors heavily inflates our throughput, drastically collapsing the final mathematical cost. These technical multipliers don't just reduce the price of a token, they automate the labor required to produce them. By baking these efficiencies into a unified OS, we eliminate the need for massive engineering teams typically required to tune and manage this infrastructure. This high-density automation is what allows a core team of just 3 people to manage a global financial architecture. This graph shows the ultimate financial paradox achieved by Sigma. The user base scales exponentially, following an aggressive upward curve, while the cost of every individual interaction plummets toward zero. The OS is entirely decoupled from the linear trap of traditional data centers. In the race to dominate AI infrastructure, the competitive advantage belongs to the ecosystem that engineers the highest intelligence output per watt at the lowest token cost.